What is a 1031 exchange? Simply put, it is an available tax break for real estate investors who sell investment property at a profit. Normally, the profits or capital gains would be subject to tax of up to 20% plus any applicable state tax. The 1031 exchange tax code was created so that investors who want to trade into another investment of equal or greater value can defer the capital gains tax almost indefinitely. This allows them to manage and grow their portfolio without having their available capital reduced when trading into another investment. But how does it work? First, the seller must not take direct receipt of the proceeds of the sale, otherwise known as constructive receipt. The monies from the sale must go to and through a qualified intermediary or accommodator who holds the funds in escrow while the replacement property or properties are identified. Once the replacement properties are identified, the accommodator releases the funds for the new purchase. Anything left over would be returned to the investor and would be taxable. Second, the new investment property or properties identified must be of equal or greater value than the property that was sold. This is very important. The replacement property cannot be of a lesser value than the property that was sold. The final and potentially most difficult element are two very important and concurrent timelines that must be met to qualify for the 1031 exchange. Namely, the replacement property or properties must be identified within 45 days of the sale date of the initial property, and the transaction on the new property or properties must close within 180 days of the sale of the initial property. Both timelines must be met for the 1031 exchange to be valid. This is a great tool for real estate investors, but it can be tricky to execute. One tool that has emerged to help investors who are in a quandary about finding replacement properties in a timely fashion is called a DST, or Delaware Statutory Trust. But we will look at that in another video.